The high returns of a mid-cap funds are in line with higher risks involved in investing in these funds. They outperform historically in a bull market, but when the tide turns, they come crashing down. With markets in an upswing, the high double-digit returns of mid-cap funds may look attractive. But do these funds fit in all investment portfolios? Let's get you all that you need to know about mid-cap funds. Well, mid-cap funds give a rosy picture if you look at returns, and let us first look at returns for a short period of time, 3, 1 and 6 months as far as these funds are concerned. Remember, these funds are based on the assets under management, and in that category, if you look at it, the top funds with maximum assets under management have already seen in a 1-year period a return over 53%, and now this of course has come at the back of the way the equity funds have, or equity markets have really done, and the mid-cap category really seen the upswing and mirroring that as far as the funds are concerned, most of them in fact outperforming what the index is. As far as 3 years is concerned, again a good picture being seen, over 28% returns are seen in this category. 6 months, of course, while it looks good, is not the time period for small investors to really consider. Let's look at the second set of the funds, which of course are smaller in size of the assets under management, but comes under the top 10 category of the assets under management. Here, if you look at the picture, all these funds in 1-year period over 59, almost touching 60% returns across, 70% in some cases as far as UTI and Franklin mid-cap funds are concerned. 3 years too, all these funds have given over 30% returns, and that of course comes in with, if you look at the entire tax benefit also, with no taxes in the long-term capital gains tax as far as these funds are concerned, is a huge sum of returns that mid-cap funds are giving even a 3-year period. But let's look at a longer period and how they fare in the longer term. These funds really, some of them of course not been there for a 10-year period, have also marked returns for about 18 to 23%, as you can see. In 5-year tenor, over 20% returns is what these funds have seen. Let's look at the other categories of these funds as well. The second lot that you can see on your screen at this point in time, also indicating over close to 20% returns in a 5-year period, and almost mirroring to about 19 to 23% range as far as 10-year period is concerned. One of the highest categories of returns across asset classes. So this, of course, but one has to really understand is that as far as the mid-cap funds are concerned, they come with their own baggage of risk. But should it be considered for a long-term horizon, just as we do all other equity categories? Do they need to be longer, be considered for a longer period of term? Let's hear what the experts have to say.
Like any investment in well-diversified equity funds, investment in mid-cap funds also has to be for the long term. There are a couple of reasons for that. One is equity as an asset class requires time commitment. So if you really want to benefit from the true potential of equity, you need to invest for the long term. The second, we need to realize the reason why we invest in mid-cap stocks. We invest in these stocks because they have a higher earning potential growth. And what happens is, because of that, they get re-rated over a period of time. So if you really want to benefit from the growth in the stocks which are there in your mid-cap fund, you need to be investing for the long term.
But let's now look at good times and bad and show you how mid-cap funds are more vulnerable when going is not good. But first, 2007, rosy picture there, no economic downturn. The question that really thereafter came about, you had all going good for the equity markets, while the Sensex gave about 47% returns. Your large cap funds had 56% returns, but your small and mid-cap did much better at over 58.3% returns, and your mid-cap index also at about 68% returns. But the going was not good in 2008, and that's when you see the entire negative impact, with the markets really crashing by about 52%. But the cuts were deeper in the mid-cap side, with about 66% down, and mid-cap fund, which managed to control of damage a bit in comparison to how the index performed, but at a negative 59%, more than what the equity markets and the large cap funds really felt the damage. Look at it in 2011, when the markets were still not out really of the woods. Again, while they were down by about 24%, both in the large caps and the Sensex in the larger category. In mid caps, the mid cap index saw much larger cut, and therefore the same was reflected in the mid cap funds category. Let's talk closer to the years that we are in, 2012 and 13. When you see both Sensex and large cap, when you see a little bit of upside that was seen after the negative that we saw for all those years, just about 8%, but the recovery was not that good as far as mid-cap category is concerned, and therefore the mid-cap funds were just marginally up by about 2%, giving the 2% returns is what we saw in 2013. 2014, the time when last 1 year when we have seen the entire equity markets in an upswing, while Sensex has given about 29% returns, the large cap at 42%, about 54% is what the mid cap index has given, but your small and mid cap funds have given over 71% returns, and that has really really made the way that we're seeing the picture as far as the small and medium cap funds are concerned. But let's understand from our experts as to what are the risks involved in investing in small and mid cap funds.
Mid-cap funds tend to have higher volatility in returns. So when we say volatility, essentially it means there is a higher fluctuation in the returns of mid-cap funds versus large-cap funds. And just to sort of take a step back and look at why do mid-cap funds tend to generate higher volatility in returns as compared to large-cap funds. Essentially, mid-cap funds, as the name suggests, invest in small and mid-cap companies. These companies, although they tend to have a potential for higher growth in business as compared to large cap companies, but these companies also are more vulnerable or more sensitive to economic downturns or economic cycles. So clearly, volatility in returns is one of the key risks in mid cap funds versus large cap funds, or higher volatility in returns as such. The other risk that comes into play with mid cap funds is the illiquidity of the underlying stocks. So, if as an investor, if you want to exit a fund during a market down cycle, you might, and therefore the fund manager needs to, possibly redeem or sell off a portion of its holdings. There could be an impact cost. So there could be a higher, slightly more negative return because these stocks are illiquid and the fund manager might find it difficult to offload or sell off the stocks at an appropriate price. Obviously, fund houses and fund managers are aware of the illiquidity risk as such, and they do take various, risk mitigating sort of measures as such. And among those, they would typically track the liquidity, ratios of the underlying stocks. So they would track what sort of liquidity do these stocks actually, have in the market over a period of time, and they would sort of maintain a portfolio which is fairly liquid, or they would have certain target, liquidity ratios within which they would sort of try and maintain, the stocks in the portfolio at. Obviously, the other thing that they do is maintain a fairly diversified portfolio.
And that brings us to the question, if you can have a mid-cap fund in your portfolio, what all you need to consider before investing in it? And is it perhaps important to consider also record of your fund manager making those crucial calls on investing in mid-caps?
First is you need to consider as an investor whether you should be investing in a mid-cap fund or not. Now, what I mean by that is, before you decide that, okay, because some of the mid-cap funds are doing very well, let's go and invest in that, you need to analyze your existing portfolio. So if your portfolio already has sizable chunk of your money invested in a multi-cap fund, the chances are that 40 to 50% of your money is already invested in mid-cap. Then the question that you should really be asking yourself is, should I increase my exposure at this level? Second is, look at how the fund has defined mid-cap stocks. So risk return profile of the fund will vary, which obviously means that you could be taking much more risk than what you would like to take. The third important thing you need to look at is how diversified the portfolio is. We all know that mid-cap as a segment is quite aggressive. So you need to invest in the fund which is very well diversified across sectors. The fourth important factor that you need to look at is how consistent the fund has been. So how do you compare the performance of the fund? You can compare it vis-a-vis its benchmark. The second option that you have is to compare the performance vis-a-vis your peer group. My advice always is, more than the benchmark, you should be looking at the performance of the fund that you intend to invest vis-a-vis the peer group, because the chances are when the markets are doing very well, every mid-cap fund will outperform the benchmark. But when you compare with the peer group, you may find that there is a difference of, at times, even 20 to 25% on a yearly basis. When you look at that, ensure that you don't look at only performance. See why there is a difference of 20 to 25%. Is it the fund is taking some concentrated bet or investing in some very aggressive stocks? So I think these are the factors you should look before you invest in a mid-cap fund. Well, one of the reasons we invest in actively managed fund is because we want to benefit from the expertise of the fund manager. So it is not different in the mid-cap. And in fact, more so I would say in the mid-cap, because the major differentiator between different funds in the mid-cap is the stock picking ability of the fund manager. So it's important to look at how the fund manager has been managing this fund. If he has been managing some other mid-cap fund, how he has done well. And it is not very difficult to find this information. You can find this in the offer document. But I will caution here that don't put too much emphasis on that, because fortunately most of the fund house now follow a strategy of having an investment committee. So the fund manager obviously remains the key guy, but there are other people also who are helping him out.
It's time now to slip into a short break. On the other side, we tell you how you can plan effectively to accumulate 1 crore in 10 years.